ALM or Asset Liability Management. So in this introduction, we will see what ALM services are. We will also see the main objectives, definitions, functions, and the ALM process. So first, ALM services are usually offered by different companies that are used by the entity bank. So the asset liability management as a function is offered by a company which gets used by the different banks. That is how it normally works. Bank manages risk with the help of ALM and maximizes profit. ALM or asset liability management does interest rate changes and manages rate structure, maturity, and risk. Management of assets is managing the trade-off between profitability and liquidity. Managing of liabilities is managing the trade-off between risk and return. Now here one thing to note is interest rate changes or interest rate sensitivity has everything to impact any bank funds, and its effects are felt in the profitability and liquidity of bank funds as well as risk and return of the bank funds. So in short, in this lecture we will discuss the main objectives of ALM, definitions of ALM, functions of ALM, and the ALM process. So first we'll see what are the main objectives of ALM. So the objectives of ALM or asset liability management, the first one is to maintain the liquidity of the bank fund. So ALM service should plan to meet the liquidity needs. How liquid a bank is what exactly has to be maintained as a result of this ALM management process. Now the second one is to reduce interest rate risk on the maturities of assets and liabilities. ALM also does currency risks. ALM facilitates banks in maximizing profitability as well as it increases wealth maximization for shareholders. So these are the objectives of ALM. Now, what are the definitions of ALM? ALM is broader than risk mitigation and is linked to investment management functions and liability. It is normally covered by an enterprise risk management and is managed by fund managers. So the asset liability management can be defined as a process of formulating strategies and revising them, implementing them, as well as monitoring them so that financial objectives are met as it relates to assets and liabilities for a given tolerance level of constraints applied as well as risks so encountered. So that is the definition of ALM. Next we will see what are the functions of ALM. So before we see that, we will have to answer some questions. Where ALM principles are applicable and what are ALM parameters? So if you ask these questions, automatically the functions of ALM is answered when you answer these questions. So where ALM principles are applicable? ALM principles are applicable to institutions and funds that may be bank, insurance companies, investment firms, pension and trust funds, commercial entities, individuals, etc. So that is where the ALM principles are applicable. Which are bank it is applicable, insurance companies it is applicable, investment firms it is applicable, pension and trust funds it is applicable, commercial entities and individuals. Now what are ALM parameters? On what basis is this management done? So some of the ALM parameters on the basis of which asset and liability management is performed is NII, NIM and EER. So what are they? NII is net interest income, is the income of a bank in terms of differences between interest earned from loans and interest it pays to its depositors. So we know the banking business. What exactly is the business of bank? Bank accepts deposits from customers, and bank also gives or lends money as loan to its bank customers actually. who are actually the bank's debtors. So the difference of interest which the bank earns by offering loan and the interest it pays to its depositors, that difference in the interest income is the net interest income, which is a parameter which the ALM uses to manage assets and liabilities. Another parameter which ALM uses is net interest income, net interest margin, which is NIM, which is basically the net interest income divided by average earning assets. That value is what is net interest margin. Another parameter which ALM uses is economic equity ratio, which is shareholders equity divided by total assets. So these are the ALM parameters which it uses, or the ALM uses these factors. So all these factors are taken to maintain short-term profits and long-term earnings by examining assets and benchmarking credit risk and contingency risk, which may be created as a result of interest or exchange rate fluctuations. So on a similar benchmark is the metric loan and investment portfolio, which gets scrutinized against foreign exchange risk and liquidity risk. So that is basically the functions of ALM. Next we will see what is ALM process. So the basic result of the ALM process, the net result of the ALM process is submitting rupee and forex reports to the Reserve Bank. So the objective here for an ALM process is basically, as part of ALM process, is to submit reports and statements to the Reserve Bank of India for structural liquidity, interest rate sensitivity, as well as dynamic liquidity for rupee reports, as well as for forex. The statements for MAP is submitted, which is maturity and position, as well as interest rate sensitivity. So these reports are submitted, and it is one of the main reason why an ALM process is done in a bank. Now the ALM process consists of 5 steps. What are those 5 steps? The first step is assess the entity's reward and risk objectives. So by doing that, what exactly the bank gets? So sometimes the financial objective and risk bearing capabilities of the bank gets revised and reorganized. So that is what happens as a result of assessing the entity's reward and risk objectives. Next step is identification of risk in each and every asset and liability. That is also part of the ALM process. So that will lead to evaluation of risks, finding causes of risk, and establishing the internal and external sources of risk and their relationship to each other. So that is what is done when you actually do identification of risk in each and every asset and liability. The next step is risk exposure measurements. So risk exposure measurements, whereby the sensitivity of risk is measured and also set an expectation for loss under a given confidence interval of circumstances. So that is the step where the ALM process does risk exposure measurements. The fourth step is strategizing to modify risk, whereby important strategies around diversification, hedging and portfolio management help to optimize reward and risk trade-off and reduce the risk measures. And finally, it constantly monitors risk exposures, and it also revises ALM strategies as they seem to fit well in the ALM management structure. So that completes the ALM process, and basically it gives an introduction to the asset and liability management done in the banks. Thanks.